Hello, folks. It is Friday, October 6th. It's about 9 o'clock on the East Coast of the United States. I hope you're having a fantastic day wherever you're located. So, in this video, I will be talking about rising interest rates. They are surging today. Let me share my screen and we'll jump right in. So, rising interest rates. What the interest rates are reacting to, I believe, is a hot jobs report. So BLS came out with a jobs report today. They're saying that 336,000 jobs were added in September. Now, if you believe that, I got a bridge to sell you. Let me tell you, it's a good bridge, and you'll be amazed at the price. But anyway, expectation on Wall Street is that 170,000 jobs would be added for September. And so Wall Street is reacting to that. If we go to the ADP report or the household survey, we have more like 87 to 89,000 jobs added was the expectation. So anyway, this is a hot jobs report, and the markets are reacting to that hot jobs report today. Just kind of a side note on the job situation. So we've got the auto workers on strike. They are asking for a 46% pay raise over 4 years. And in my mind, this is just an indication of where we're at with inflation. You know, the fact that we've got auto workers on strike and they're asking for a 46% raise. I mean, that's a tremendous raise. I mean, I'd like to get a 46% raise, wouldn't you? And then just another anecdotal insight into the jobs market and inflation. In California, they just passed legislation as of April of 2024, they will be all of the large franchise fast food restaurants will be mandated to pay a minimum wage of $20 an hour. Now, in my opinion, if you're wondering when your job will be replaced by a robot or just done away with because it's no longer needed or no longer economically viable, it's when you got a mandated minimum wage of $20 an hour for flipping hamburgers, or you're an auto worker asking for a 46% raise. I mean, you ought to be looking over your shoulder and waiting for the robot to tap you on the shoulder, in my opinion. But we're at an interesting point in the economy of the economies of the Western world. So anyway, let's keep rolling. This is the BLS report, October 6, 2023. We got a employment rose by 336K in September, unemployment rate at 38%. And I knew I wanted to add something here. Let's go to shadow stats right quick. And I think if we look at, so this is John Williams' website. And so he tracks economic statistics based on the same methodologies that the BLS used back in 1980. And that was before they introduced all the multiple ways that they massage economic statistics to make them look better. And so here we are. This is shadow stats. He is showing current unemployment rate at 25%. So shadow stats, 25%. BLS 3.8%. I just don't know what to say. I mean, that's a 22%, 21% discrepancy between those two numbers. That's just amazing. And again, I suspect that John Williams is far more accurate in his assessment of the economic situation. And again, this isn't John pulling numbers out of his tuchus. He's using the exact same methodologies that the BLS used back in 1980. And based on those methodologies, unemployment's currently 25%. So, just wow. Anyway, so interest rates are surging today. What I'm going to do in this video, we're going to look at the interest rate charts across the duration curve. Here we are. This is yield on the 1-year Treasury bill in the weekly time frame, just flat. But notice that it's flat at, what is that, 5.379, almost 5.4%. So flat at a high level. And what is significant in this chart to me, one of the things, so we get this big surge, big impulsive surge up to a higher level, poke through 5%, all the way up to 6%. So notice that the high on this instrument in this time frame, 6% interest. So we reached 6%. Then we got a pullback. Basically, we pulled back and tested the breakout level. And this is very common in financial markets where you get a breakthrough and then a pullback to test the breakout level. And so that's exactly what we saw here. Then we got a little bit of a push higher, and now we're in a sideways consolidation. Another way this could be referred to is a high consolidation, and that's in contrast to a pullback where you might see yields headed significantly lower, like a Fibonacci 38%, 50%, 62%. But we're getting a high consolidation here, finding support along the 10-week moving average. Reasonable to expect, or based on technical analysis, what I would expect is that this is a gathering of energies. Basically, this financial market is consolidating in a sideways motion while it gathers energy for its next move higher. And we'll see that in some of the other charts. And so anyway, general assessment, in my opinion, we've had big moves on the short end of the duration curve. They are currently in consolidation mode at high levels, while what is happening in recent weeks and currently is that the long end of the duration curve is moving dramatically higher. But I fully expect we'll see it. We will see the short end of the curve headed higher as well. So this is my favorite chart. Yield on the 1-year Treasury bill in the monthly time frame. In my opinion, what this chart shows us, when it goes vertical, bad things are happening in the economy. And so we can see, there was the global financial crisis, 2008. That was the big scary plunge in 2020. And now we don't really have a name for this one yet because it's not over. We're not done with this move yet. In my, internally, what I am naming it, this is the global debt collapse. And, I talk about this all the time. I believe it was triggered December 2021 when Evergrande defaulted on $300 billion in debt. I don't have it marked on this chart, but in March of 2022, which is, right in, where's it at? February, March. So right there. So March of 2022, that's that big candle right there. That was when the yield on the 10-year Treasury note broke out of its 40-year downtrend. And so that was that big impulsive candle there. And so anyway, this is in my mind, if you only had one chart to look at, to assess interest rates, this would be it. And again, when this chart is moving vertically, bad things are happening in the economy. Notice that currently we're in a sideways consolidation. And again, high consolidation, not a pullback, not a correction. This is basically just a pause while this instrument gathers energy for its next move higher. That's my opinion. Now, note, based on MACD, this instrument is terribly overbought. You know, we're way up into nosebleed levels as far as overboughtness. We have to go all the way. Oh, isn't that interesting? So let's draw a line in here. So we have to go all the way back to 1981, late 70s, to reach a level where this instrument, based on MACD, was as overbought as it is currently. But also notice, this is important in my opinion, notice that we are not at this level of overboughtness yet. There is still room for this instrument to move higher based on MACD. And so, you know, that's interesting. Yeah, that is interesting. So tremendously overbought, but not as overbought as it was back in 1981 when interest rates peaked. You know, interest rate on the 10-year note peaked at almost 16%. So here we are. This is the 1-year Treasury bill in the weekly time frame. Again, sideways consolidation at a high level, 5.44%. MACD in bull mode, suggesting that the primary trend is upwards, and that was true of the charts that we just looked at. Primary trend is upwards based on MACD. Currently on a sell signal, energy is low in this instrument in this time frame. I was just chatting with one of my associates, friends, just on Wednesday about how this is one of the factors that is drawing money out of the banking system, because investors are looking at yields on treasury notes and they're taking their money out of banks. You know, banks, your savings account is paying, 0.2% interest. And so it's kind of silly to let money sit there in a banking account drawing essentially zero interest when you can go put that same money into a 1 year, or actually what I was telling my friend was a 3-month, put your money into a 3-month treasury note, which is yielding not quite 5.44. I think it's at 5.39, something like that, but well over 5% interest. Treasury bills are considered to be zero risk. That's not my assessment, but balance the risk in a treasury, bill, note, bond against the risk of leaving money sitting in a bank account. Everybody says, oh, well, I'm insured by the FDIC up to $250,000. Well, if you look into the financial situation of the FDIC, what you will find is that they have about $125 billion in assets, and yet they are insuring 18 trillion with a T in assets. And so if you think that your bank account is protected by the FDIC, it's simply not the case. $125 billion protecting $18 trillion worth of assets. And so some analysts that I've seen talk about this situation, what they think will happen, if we had a widespread banking collapse where the FDIC had to step in and make good on their guarantees, it's basically you'd get a piece of paper from the FDIC saying, hey, we got you covered, not to worry, you're not going to lose any money. You just can't have it right now. And so what good is it? You get a piece of paper from the FDIC saying, someday in the future we'll pay you back your money. That's not a guarantee. But anyway, that's just me blathering. So this is yield on the 2-year note in the weekly time frame. Couple of things to notice here. Megaphone pattern. And so if you look at McGee and Edwards, that's the Bible for technical analysts. What they will tell you about the megaphone pattern is that it typically resolves to the upside. And visually, we can kind of see that it looks like this instrument it's not a sideways consolidation as much as an upward trending consolidation, sideways with an upward bias, where this vehicle is gathering energy again for its next upward push. And back to Edwards and McGee, that's what they say about this megaphone pattern, is that it tends to resolve to the upside. Now, if we look at, long term, we can see that we're pushing up against this, what is that, 5.276, right in there somewhere. There appears to be a demarcation point, a horizontal support resistance level at 5.2, almost 5.3. And again, we're pushing into, resistance at that level. Energy is very elevated based on stochastics, MACD in bull mode. Currently on a buy signal, still on a buy signal, close to signaling a sell signal. But again, my expectation based on this chart would be for higher rates on the 2-year. And actually, when you see an instrument gathering energy, high consolidation like this, whether it's sideways or sideways with an upward bias, when these kind of patterns resolve, they tend to do so impulsively. And so it wouldn't be surprising to me to see an impulsive bar higher as price or yield in this case breaks through that 5.3 level. So let's keep rolling. Wait a minute. OCD, got to save that chart. This is the 2-year in the monthly time frame, and it's the same thing I was just talking about. It's that we appear to have a horizontal support resistance level around, somewhere between, call it 5.2 and 5.4, maybe 5.5. So somewhere in there, horizontal support resistance zone, currently gathering energy below that level, in preparation for a push higher above that level. Notice, however, that based on MACD, we're very overbought, which would suggest that perhaps, we need a correction, or we need some more time to work off that overbought level, more sideways consolidation. But MACD is in bull mode, suggesting that the primary trend is upwards. And of course, energy elevated based on stochastics. This is yield on the 5-year note in the weekly time frame. More of the same. Breakout through. This was 1, 2, 3, so triple top, and then a break through that level, pushed up to resistance at the median line of this Andrews pitchfork, and then pulled back a little bit. And so if we look, let's pop down to the daily time frame. We can see, let's see, the high, that was 4.875. So overnight on the 4th, October 4th, which I think was Tuesday, this instrument pushed up to almost 5%. MACD in bull mode on a buy signal, and energy very elevated. So dealing with resistance here at the median line, but expectation that this instrument will push higher, perhaps come back down and test the breakout level. That would not be a surprise if we saw this instrument pull back to 4.5 or so, 4.6, test this breakout level, and then head up on its next leg higher. This is yield on the 7-year bond, weekly time frame. This one actually tapped 5%. So if we look at, well, no, it didn't. Excuse me. Let's drop down to the daily. There was 4.91. So popped up to 4.91%. Pushed up through resistance at the upper median line of this modified shift pitchfork. Fairly overextended from the 10-week moving average. So again, it wouldn't be unreasonable to expect a little bit of a pullback here, or maybe some sideways action. But again, MACD in bull mode on a buy signal, and yet to reach overbought level based on MACD, which would be somewhere up in here. So we've got a ways to run before this instrument reaches the overbought level. Lots of energy based on stochastics. So high energy level based on stochastics, suggesting that there is a lot of energy for higher rates. And again, what we're starting to see as we transition, here's the 2-week and lower durations basically consolidating sideways action. But then as we start to look at the 5 and the 7, and as we continue with the longer duration bonds, notes, this is actually a note, I believe. At 7 years, we're still in the notes. Up to 10 years, I believe, is a note, not a bond. But at the longer end of the duration curve, we are seeing rates move higher currently. And that's what we're seeing in this chart. Let's keep rolling. Here's the 10-year Treasury note yield on that instrument in the weekly time frame, pushing higher, pushing up into resistance at the median line of this Andrews pitchfork. MACD in bull mode on a buy signal. And again, we've got a long ways to run before we run into the overbought level based on MACD. Energy very elevated. Might get a little bit of a pullback just because we're dealing with this resistance. But again, this is a bullish chart suggesting that higher interest rates are to come. Let's see, the high on this instrument was 4.88 just in the last couple of days. Here's the yield on the 20-year bond, weekly time frame again, strong move higher, MACD in bull mode, long way to go before we reach the overbought level, and elevated energy, very, very high energy. So lots of energy to move, continue moving to higher interest rates. High on this instrument was 5.25. And so let's pop down to the daily time frame. So let's see, that was just today. High of 5.25. So as I was saying, interest rates moving higher based on this hot jobs report. I mean, that's one of the factors. I think another factor is that investors are, they've had some more time to digest the last report from the Fed, where they're talking about higher for longer. And then they're seeing, in the rest of the world, interest rates are moving higher as well. Europe and Japan, interest rates are moving higher. I think investors are digesting or accepting the idea that interest rates are moving higher. It's just that's where we are at economically. In my opinion, interest rates are moving higher. They will be moving higher for years to come, or at least until the wheels come off the bus. I mean, forgive me for chuckling about that, but if you don't laugh at this point, you're going to cry. So this is yield on the 30-year bond in the weekly time frame. Again, big impulsive surge higher. Let's see, what was the peak? 5.05. So just over 5%. Let's look at the daily chart. Yep, that just happened today. So, high 5.05. So just today, we had the yield on the 30-year bond poke over 5%. And of course, that's the target that I've been expecting us to reach was 5%. We're there. MACD in bull mode on a buy signal. Got a ways to go before becoming overbought based on MACD. Energy very elevated, suggesting that we have more. We've got energy and we've got room for higher rates. Based on Andrew's pitchfork, this is a shift pitchfork. We'd look at the target as being, 5.3, 5.4, somewhere in there. If we're going to place a bet on where is this instrument headed, we'd be looking at, something up in there as a target for this instrument. Let's keep rolling. This is yield on the 30-year in the monthly time frame. I wanted to see, when was the last time we were at these levels? So well over 5%. What is that? Or just at 5%, excuse me. We have to go all the way back to June of 2008. And so decisive, impulsive move through those interest rate levels of 2008. MACD in bull mode on a buy signal. This is as overbought as we have been in this instrument based on MACD going back as far as I've got data for, which is 1989. Energy very elevated based on stochastics. So let's see, one more chart. This is the yield curve. And what I wanted to show here, recessions tend to occur based on the yield curve as an indicator, a forecaster of economic recessions. The recession occurs after the yield curve heads back up. And so we see that here, yield curve heads back up above the zero level. There's the recession. Zero level, there's the recession. Zero level, there's the recession. And so the curve has started up, has not climbed above zero level yet. But anyway, there is an economic recession in our future. And based on the level of inversion, the level of this, down into negative territory on the yield curve, it would not be unreasonable to expect that the upcoming economic recession is a doozy. It's not going to be some short-lived affair like this, or a fairly long, let's see, that was January of 2008 through July of 2009. So that's, 15 months. 15 months? No, 12, 17 months. So a year and a half, basically. It would not be unreasonable to expect or assume that the economic recession based on this yield curve, 2 years, 3 years, something significant. And again, until the wheels come off the bus, One of my expectations is that all paths from this point going forward lead back to gold as money. And of course, when we actually implement gold as money, we should, or reasonable to expect in my mind, we will get an immediate positive impulse throughout the economy when people and investors see that we're returning to honest money, honest economy, backed on gold, an exchangeable gold currency. All economic factors will immediately improve. And so maybe we don't get a 2 or 3 year economic recession. It doesn't last that long, but we have to get there first. We're not there yet. As I've said in multiple videos, protect yourself, please. Do whatever that looks like for you. Do something to protect yourself. Grab some extra food next time you're at the grocery store. Keep your gas tank full. It doesn't cost any more to run your vehicle with a full gas tank than to run it with an empty tank. I mean, it's always silly. It's always frustrating. I get in somebody's car that, I got to stop at the gas station. Well, no, just run it full. Doesn't cost you any more to run your vehicle with a full gas tank. Have some cash on hand, buy physical precious metals, store them where you have ready access to them, protect your tax-advantaged retirement accounts, move some 5 to 10% of your retirement savings into physical precious metals. And of course, that means a precious metals IRA. In the description below this video, you'll find a link to Augusta Precious Metals. I say this every time. That's the company that, if you ask me which Gold IRA company should I go with, it would be Augusta Precious Metals. If you reach out to them, they'll provide you with an information kit. They'll work with you for as long as you express interest in investigating a precious metals IRA. They'll help you determine whether that instrument is appropriate for you, your investment horizon, your time horizon, your parameters for investing, and your tolerance for risk, and they won't pressure you during that process. They are there to answer your questions, again, help you determine if a precious metals IRA is appropriate for your personal circumstances. And so anyway, I just wanted to take a look at interest rates across the duration curve, because they are surging higher today, at least in part based on this hot jobs report. And I don't think I said anything about it, but yeah, I did implicitly. Looking at the difference between shadow stats at 25% unemployment and the BLS wanting us to believe that unemployment is 3.8%. Question everything you see. Look for a secondary source to confirm or deny any information that you have. Doesn't matter what you're talking about. Health information in particular at this point is particular because COOF and everything. But as investors, economic data, look for a secondary source of information. And of course, Shadow Stats is an excellent source of information about both unemployment, inflation, money supply, CPI, GDP, etc. Just question everything at this point. And so I'm going to shut up now. Been a pleasure talking to you this morning, and I look forward to talking to you in the next video. See ya.